Hey everyone! Welcome back to the channel. Today, we're jumping into part 1 of our complete technical analysis masterclass. If you've ever seen traders reading charts like they're reading a book, and you wondered what exactly they're looking at, then this series is for you. Technical analysis sounds complicated, but it's actually built on simple, visual concepts. There's no need for advanced math, no complicated formulas, no PhDs required. In today's video part 1, we're covering the foundation, what technical analysis really is, why traders rely on it, different chart types, candles versus bars versus lines, time frames, and which one you should use, trends, trend lines, support, and resistance. By the end of this episode, you'll already know more than most beginners. This is the essential groundwork before you move into indicators, candlestick patterns, and strategy building, which we'll cover in part 2. Section 1. What is technical analysis? Let's break down the first big question. What exactly is technical analysis? In simple terms, technical analysis is the study of price movement and market behavior using charts. It's all about answering 3 questions. 1. Where has price been? 2. Where is it now? 3. Where might it go next? And technical analysis is based on 3 core principles. Number 1. Market action discounts everything. Everything known as news, emotions, fundamentals is reflected in price. If a company releases bad earnings, the market reacts instantly. If investors are hopeful, price reflects that too. Price tells the whole story. Number 2. Price moves in trends. Markets don't move randomly. They move in identifiable directions, up, down, or sideways. Recognizing these trends is one of the most powerful skills a trader can have. Number 3. History repeats itself. Markets are driven by human psychology. Fear, greed, panic, excitement. These emotions create repeating patterns on the chart. That's why chart patterns from decades ago still work today. So technical analysis isn't magic. It's simply learning how to interpret the behavior of millions of market participants. All reflected through price. Section 2. Types of charts. To understand price, you must understand the types of charts traders use. Let's go through the 3 most important ones. 1. Line chart. This is the simplest chart. It connects closing prices with a line. Good for beginners, easy to understand. Shows overall direction, but it hides important details like the high, low, and open for each time period. 2. Bar chart. The bar chart includes more information. Open, high, low, close. But visually, it can look crowded and harder to read quickly. 3. Candlestick chart. The most popular. This is the most widely used chart by traders. Each candlestick shows how high price went, how low price went, where it opened, where it closed, and whether buyers or sellers were in control. Green candles represent bullish movement. Red candles represent bearish movement. Candlestick charts give the most information in the most visual way. If you're serious about trading, candles are your best friend. Section 3. Time frames. Next, let's talk about time frames, one of the most important decisions a trader makes. A chart can be divided into different time units. 1 minute, 5 minute, 15 minute, 1 hour, 4 hour, daily, weekly, monthly. Each candle represents the price movement during that time. Different traders use different time frames. Scalpers use 1 minute or 5 minute charts. Fast, high-frequency trades, day traders use 5 minute to 15 minute charts, multiple trades per day. Swing traders use 1 hour, 4 hour, or daily charts. Hold positions for days or weeks. Long-term investors use daily, weekly, monthly charts. Look at long-term trends. Rule of thumb. Higher time frames equals stronger signals. Lower time frames equals more noise. A trend on a 1 minute chart might be noise on a daily chart. Section 4. Trends and trend lines. One of the first things you want to identify on any chart is the trend. Price can only move in 3 directions. 1. Uptrend. Price makes higher highs, higher lows. Buyers are in control. 2. Downtrend. Price makes lower highs, lower lows. Sellers dominate. 3. Sideways. Consolidation. Price moves horizontally. Neither buyers nor sellers have full control. Sideways markets often lead to major breakouts. Trend lines. Trend lines help you visualize trends. In an uptrend, draw the line by connecting to or more rising lows. In a downtrend, draw the line by connecting to or more falling highs. What do trend lines do? They act like support in an uptrend, resistance in a downtrend. When price breaks a trend line with strong momentum, it often signals a trend reversal. Identifying trends and trend lines is one of the simplest but most effective tools in technical analysis. If you can identify the trend early, you're already ahead of most traders. Section 5. Support and resistance. Now let's talk about one of the most important concepts in all of chart reading: support and resistance. Support. A level where price tends to stop falling and bounce upward. It's an area where buyers step in. Resistance. A level where price tends to stop rising and pull back. It's an area where sellers take control. Where do these levels come from? Are previous highs, previous lows, psychological levels, 100, 500, 1000, 10,000, trend lines, moving averages. The support-resistance flip. This is a key rule. When price breaks above resistance, gives resistance becomes new support. When price breaks below support, gives support becomes new resistance. This flip reveals shifts in market power between buyers and sellers. And that completes part 1 of our full technical analysis series. You now understand the essential building blocks. What technical analysis is, how market psychology affects charts, chart types and which one to use, how time frames impact your strategy, how to read and draw trends, how support and resistance work. In part 2, we're going to take everything deeper. Technical analysis, part 2. This is part 2 of our complete technical analysis masterclass. If you haven't watched part 1 yet, I highly recommend starting there. We covered the foundations like chart types, trends, time frames, and support resistance. Today, in part 2, we're level up. We're diving into candlestick patterns, technical indicators, chart patterns, volume, and finally, how to combine everything into a simple beginner-friendly trading strategy. This episode is fully beginner-friendly. No complex math and no complicated formulas, just pure, practical chart reading. Let's jump in. Section 1. Candlestick patterns. In part 1, you learned what candlestick charts are. Now let's explore the real power of candlesticks. Candlestick patterns. Candlestick patterns help traders identify reversal signals, continuation signals, and overall market psychology. Let's go through the most important ones every beginner should know. 1. Hammer. A small body at the top, a long lower wick. Appears after a downtrend, meaning buyers stepped in aggressively and rejected lower prices. Signal. Possible shift from selling pressure to buying pressure. 2. Shooting star. A small body at the bottom, a long upper wick. Appears after an uptrend, meaning buyers tried to push price up but got rejected by strong selling. 3. Bullish engulfing. A large bullish candle fully covers the previous bearish candle, meaning strong momentum shift toward buyers. 4. Bearish engulfing. A large bearish candle engulfs the previous bullish candle, meaning sellers have taken control. 5. Morning star. A 3-candle pattern. Big bearish candle, small indecision candle. Strong bullish candle, meaning momentum turning upward. 6. Evening star. Opposite of morning star, signals downside reversal. You don't need to memorize every pattern. Focus on learning what they tell you. Who's in control? Buyers, sellers, or no one? Section 2. Indicators. Indicators are tools added to the chart that help you understand momentum, trend strength, and potential entry signals. Let's break down the 3 most important ones. 1. Moving averages. A moving average smooths out price and shows the overall direction. Types: SMA, simple moving average; EMA, exponential moving average, more sensitive to recent prices. Common signals: price above moving average equals uptrend, price below moving average equals downtrend. Crossovers: short-term MA crossing above long-term MA gives bullish, short-term MA crossing below long-term MA gives bearish. Many traders use combinations like 20 EMA, 50 EMA, 200 EMA. 2. RSI Relative Strength Index measures momentum. Values range from 0 to 100. Above 70 equals overbought, price may pull back. Below 30 equals oversold, price may bounce. Our SI helps avoid chasing price in overheated conditions. 3. MACD Trend Plus Momentum Indicator. MACD consists of MACD line, signal line, histogram, signals. MACD crossing above the signal line gives bullish momentum. MACD crossing below the signal line gives bearish momentum. MACD is useful for spotting early trend shifts. The key with indicators is not to overload your charts. Most professionals use only 2 or 3 indicators at a time, usually RSI, MACD, and a moving average. Section 3.0 Chart Patterns. Chart patterns form when price creates recognizable shapes over time. These shapes reflect the psychology of buyers and sellers. Let's go through the most important categories. Reversal patterns. 1. Head and shoulders. One of the strongest reversal patterns consists of a left shoulder, a higher head, a right shoulder. When the neckline breaks, the trend often reverses downward. 2. Double top. Price touches the same high level twice and fails to break. Indicates bearish reversal. 3. Double bottom. Opposite of double top. Price touches a low twice and rejects it. Signals bullish reversal. 4. Rounding bottom. A slow, gradual shift from sellers to buyers. Often seen before major trend reversals upward. Continuation patterns. 1. Flags. Brief consolidation after a strong move. When price breaks the flag, the trend continues. 2. Pennants. Similar to flags, but triangle-shaped. Quick consolidation between converging trend lines. 3. Triangles. Types: ascending, descending, symmetrical. Breakouts from triangles often indicate continuation of the prevailing trend. These patterns are everywhere in the market. Once you learn how to spot them, you begin to see structure instead of chaos. Section 4. Volume Analysis. Volume tells you how strong a price move really is. Think of volume as the energy behind a move. High volume means strong participation, strong trend or breakout, higher reliability. Low volume means weak moves, fake breakouts, low conviction. Key principle: breakouts with high volume are far more trustworthy. Examples: if price breaks support with huge volume, gives strong bearish momentum. If price breaks resistance with weak volume, might be a false breakout. Section 5. Putting it all together. Simple strategy. Now let's combine everything into a simple strategy that beginners can use. This is a basic, clean system using trend direction, support or resistance, candlestick confirmation, RSI or MACD, volume. Step-by-step strategy. 1. Identify the trend on a higher time frame. Use moving averages. Price above 50 EMA equals uptrend. Price below equals downtrend. 2. Mark major support and resistance levels. Use previous highs and lows. 3. Wait for price to reach a level. No chasing. Patience creates consistency. 4. Look for candlestick confirmation. Examples: hammer at support, engulfing at resistance. 5. Use RSI to MACD to confirm momentum. RSI oversold at support gives strong buy signal. MACD crossover in trend direction gives added confirmation. 6. Check volume. Higher volume equals stronger signal. 7. Set clear stop loss and take profit levels. This is risk management, essential for survival in trading. And that wraps up part 2 of our technical analysis masterclass. At this point, you understand, with these skills, you're no longer guessing, you're analyzing. You're reading the market instead of reacting to it. If you enjoyed this masterclass, make sure to like the video, subscribe, comment. Thanks for watching, and as always, trade smart, stay patient, and I'll see you in the next one.